Hello people, very good to all of you. So guys, we're doing this chapter on basic accounting terms, and up till last class guys, we have understood the certain terms that comes under liability side of the balance sheet, right? So we understood overall what is the meaning of liabilities. Then we understood what is capital. We understood what is trade payables. More specifically, we had a discussion on creditors aspect. Bills payable, I said you that we'll be discussing exclusively in the bills of exchange chapter. We also understood what is drawings, what is loan, right? So far we have seen only few terms of liabilities. I'm not saying we've seen all the cases of liabilities. We've seen only few samples of liabilities. So before I go forward, guys, please tell me what is the primary motto of preparing the accounts? What is the primary purpose of preparing the accounts?
Profit loss. Yeah.
The profit bar loss and to ascertain the financial position. So how do I get to know what, by preparing what statement, guys, will I get to know the profit and loss of the business?
Trading and P&L account.
We'll prepare a statement called as trading and P&L. P&L stands for profit and loss account. And for me to know what is my financial position, for that the statement that I'm supposed to prepare is
balance sheet.
Balance sheet. Trading and P&L account will capture all the information pertaining to income, or you can say gain, then expenses bar losses. Balance sheet will capture all the information pertaining to assets, liabilities including capital. Clear? So if I have to just give you an outer line about the format of trading and P&L account, just for knowledge purpose, this is your trading and P&L account, which is T-shaped format. So this is your trading and P&L account. This is left hand side. This is right hand side. This left hand side and right hand side will be replaced in future by the word debit and credit. I haven't put debit and credit because I haven't taught you what is debit and credit yet. Okay. So left hand side you record all your expenses and losses. On right hand side you record your income and gain. So if let's suppose my income is 100 rupees and if my expense is 80 rupees, so balance 20 rupees is going to be my profit. So this is my income, this is my expense, this is my profit. So this is one way of presentation. Normally, how do I present it? One way is that my income is equal to 100. From that, if I minus expense of 80, I'll get profit 20. Right? This is one way of presentation. Another way of presentation is what? Income minus expense is equal to profit. 100 minus 80 is equal to 20. But ultimate motto of calculation is same. Presentation is different. So here the presentation is done in this way. Are you able to follow? So this presentation is designed in such a way, guys. At the end, if you do the total of the left hand side, if you do the total of the right hand side, it will be 100. This is to have a check. This has been done. So this is nothing but, for example, I buy a pen costing 10 rupees. Will I send it? Well, sorry, will I sell it as it is for 10 rupees? What will I add to it? I'll add my profit margin. So can I say expense plus profit is equal to selling price? Selling price is nothing but income. So I'll write income here. So let's suppose my profit is 5 rupees. So what is my total income? Income should not be the right word. It should be selling price. Instead of expenses, I'll put the word cost price here. Cost is nothing but expense. So my expense is 10 rupees. My profit is 5 rupees. And my selling price is 15. Now let's suppose if this is missing. Can I say this will be X? So profit is equal to, you will take this 10 rupees to the other side. So plus 10 will become on the other side minus 10. So 15 minus 10 is equal to 5 is the profit. So same way here also, guys. From 100 rupees, if I minus 80 rupees, you'll get 20 rupees. So expense plus profit, the center line I told you is like equal to expense is cost plus profit is equal to my income. So center line, guys, always when you have left hand side, right hand, the right hand side, the center line always denotes as equal to in your mathematics. Clear with this point? Okay. Now, if I have to give you a format of balance sheet, again, it's a T-shaped account. Balance sheet. This is left hand side. This is right hand side. Left hand side stands for liabilities. Right hand side is assets. So here in liability side, you have two things. That is internal liability. Another is external liability. Internal liability means capital. External liabilities, will keep it as external liabilities itself. So that is why they say that liabilities is equal to capital plus external liability. Are you able to follow? So internal liability is the money that the business owes to the owner. If business has to pay the money to the owner, it is called as internal liability, which is capital. Sometimes capital plus the savings. Savings here in business, we term it as reserves and surplus, R&S. R&S is nothing but your savings. This put together is called as internal liability, which is the money that business owes, or which the business has to pay to the owner in future. If business has to pay the money to the third party, to the outsiders, that is called as external liability. So liability is nothing but, if I have to remember to make the payment to somebody in future, then I will record on the left hand side of the balance sheet. Asset. So asset is something I told you which you own it. If you remember, I gave you the 2 pointers in the last class. What is asset? Asset is something that the business owns. You own it. Business owns it. Or asset is something that the business is expecting to receive in future. So if you come across any item which is satisfying this criteria, it is asset. If you come across any item that is satisfying this criteria, this is asset. What is the meaning for liability? Liability is something, in simple language, that the business is expecting to pay in future. You can keep it here. Yeah. Liability is something that the business is expecting to pay in future. Any problem here? No problem. Okay. What is asset? Asset is any physical thing or right or property. The term is owned by the business. Anything that the business owns is asset. Primary, you're owning what? You're owning a thing. For example, you can say plant and machinery. It's a thing, no? Right? Which can be, physically touched. So it is not necessary it should be a physical thing. It can be a thing. Physical thing is not necessary. I'll discuss about it very soon. So something which you can touch or not touch, but you can own it. Somewhere you are having a owning of rights. What is rights? We'll discuss in examples. Owning of a property. So anything that business owns, and that should have a monetary value to it. It should have some value to it. For example, you're having a machinery in your business which has got zero value. That has become scrap. You're about to throw it just like that. It has got zero value. Will I record that in my books of accounts, or will I keep it in my books of accounts? No, I'll throw it. So I will have only those assets in my books of accounts which has got some value to it. Because accounting, everything should be measured in terms of money. So monetary valuation should be possible. Or asset is anything that needs to be received by the business enterprise in the future. These are the 2 points. Basic classification for asset. And we are going to discuss again in detail. Now, assets can be classified into 3 categories: non-current asset, current asset, and fictitious asset. What is non-current asset? What is current asset? What is fictitious asset? This is too early for you to understand, because these are the terms that you will mainly come across in your 12th standard, especially when you do the company accounting. In company accounting, the balance sheet, the rule has said that, we should use the words such as non-current asset, current asset, and fictitious asset. Whereas now we are learning to prepare the balance sheet for a sole proprietorship concern. So here for sole proprietor, there is no necessity that you should classify any asset as non-current or current or fictitious. So as a sole proprietor, what they do? This is the balance sheet of a sole proprietor or even partnership concern, which you learn in 12th. This is liabilities. This is asset. They don't put any categorization as such. They'll record as first fixed asset. Under that, you'll have tangible asset, intangible asset. Then you'll have assets such as cash, bank. It comes under fixed asset. Building comes under fixed asset. So under fixed asset, we have tangible asset category. Under tangible asset, you'll have building coming in. So I'll put it here. So under tangible asset, you'll have building, land, plant and machinery, etc. What is tangible? I'll discuss. Don't worry. Next category is intangible asset. ITA stands for intangible asset. Goodwill, patent, trademarks, etc. Then you have another category called as cash, bank, stock, debtor, etc., etc. So here, as such, in the sole proprietorship concern, there is no need to classify something as current, non-current, etc., etc. So I'll be discussing about this not so soon when I do the balance sheet part, or maybe there is some chapter in between where they'll ask you to do balance sheet in this, format, just for example purpose. So that time I would discuss what it is. If not, at the end of today's session, if time permits, I'll just give you an idea, because about this you will understand in detail in your 12th standard, in your 3rd volume of TS Grammar. And it is not that easy to understand in one shot. But I'll just give an outer line because it is that theoretically in your textbook. To just make it simplified understanding, I'll explain it maybe at the end of the session today. Assets are the economic resource of an enterprise used by the business in its operation. So what is asset? Asset is something which is used in the business, or which is getting generated in the event or the course of the business, which is going to enhance my income. For example, building. Can I say this building is going to help me to increase my earning capacity? More building, more income. More land, more income. More plant and machinery, more income. Cash. It is an economic resource of an enterprise used by the business in its operation. So can I say cash is something which you're using in the business operation? You will spend money to buy goods for the purpose of selling it. So all the asset is basically are those items which you are going to use in the business operation on day in, day out basis. Land and building I'm going to use in the business. Goodwill, patent I'm going to use in the business. Cash, the money which is there in bank account, I'm going to use in the business. The money that I'll get from debtor in future, I'll use in the business. The stock that I have, I'll use it in the business. So asset are the resource of a business enterprise to be used in its business operation. So asset is something which you'll use day in and day out in your business operation. Point number 1. Asset has useful life more than 1 year. Now, let's suppose I'm buying a car, or let's suppose I'm buying a plant and machinery. I need to spend money for that. So will you treat this plant and machinery as expense, or will you treat it as asset? Versus, I compare this with, let's suppose I'm buying eraser. For buying an eraser, I have to make the payment. For buying a plant and machinery, I have to make a payment. Now you have to tell me in this which is expense and which is asset. Are both expense, are both asset, or any one is expense or any one is asset? Both are expense is the answer. Okay. Others. Both are expense, both are asset. Okay. We'll tell everything, sir. Both are both. Machinery is asset. Eraser is expenditure. Okay, that's what Vishti says. Other people. Nayarika, Ananya, what do you say? Out of these two, which is asset, which is expense? Are both assets, are both expenditure? So 3 options. And 4th option is all the above. She said no, both.
I do feel it's all the above.
So, plant and machinery per se is asset. Eraser is expenditure. Now you may ask a question, how sir? Because for both you're spending the money. Now, how did you decide this is asset and this is expenditure? This is decided by keeping into the mind the concept of revenue expenditure and capital expenditure, which you'll be learning in the upcoming classes. So how do they say something is an asset? Because for both the cases, money is being spent. So for something to be treated as asset, you should own it. So plant and machinery, I own it. Eraser also, I own it. Okay. Anything that you own is asset. Second, when I'm telling, okay, now Vishti is saying, sir, eraser is not going to generate, income. So that is the reason it is treated as expenditure. But what is the meaning of expense? Expense is treated as expenditure only if it is helping directly or indirectly in earning the revenue. So expense also is going to help you in generating the business. Plant and machinery is also going to help you in generating the business. So now again, point of confusion is come. So asset is something you own. And from asset, you're expecting the benefit to come to you for more than one financial year. The benefit from using it will come to more than one financial year. More than one financial year. FY. FY stands for financial year. Which means what? If I buy a plant and machinery, can I say I'll be using it for more than 1 year? At the end of today, that is at the end of the current year, will I throw it off? Will I sell it? Or will automatically the plant and machinery die? Not possible. So here the benefit is coming from more than one financial year. In case of expenditure, there could be 2 possibilities. The benefit can be more than 1 year. The benefit can be more than 1 year, or the benefit can be less than 1 year, or up to 1 year. Then how do you differentiate, sir? Because here also you own it, here also you own it. Here, let's suppose the benefit is coming for more than one financial year. An eraser, let's suppose calculator, sometimes they come for more than one financial year. So what is the point of differentiation? Asset is something what you own. Asset is something that you're getting benefit from for more than one financial year. One more point of differentiation is the amount involved. This is something not in your syllabus, because as a CA, I have learned this, I can tell you. There's a rule which says that if you're having amount up to 5,000, if the amount that is spent is up to 5,000, and that is helping you to own something, and that is giving you life more than 1 year, and the amount is up to 5,000, in that case, you can treat that as expenditure, which means what? Straight away, you can record this 5,000 as expenditure and finish it off. Whereas, if the monetary value is more than 5,000 rupees, you have to compulsorily take this to the balance sheet as asset. By taking this balance sheet to asset, what is the benefit? Then what will happen to that asset? Will the value of that asset be 5,000 throughout? Will it go up? Will it come down? That is something you'll get a clarity in the depreciation chapter. So the ultimate point of difference is this point. If the monetary value is more than 5,000 rupees, let's suppose 6,000 rupees, you can take that item to the asset. Now, sir, is this 5,000 100% to be followed? You can follow a different amount. Now, every enterprise is supposed to have a policy called as accounting policy. You can customize your own accounting policy. If you are not having any policy, if you are not having any accounting policy, the general accounting policy will be followed. So the accounting rules and regulations is there. You can follow that. Or if you want, you can customize that. So general accounting policy says that if the amount is up to 5,000, then you can treat it as expenditure. More than 5,000, you can treat it as asset. But you may say that, no, sir, we want to change this policy and we want to make that limit 1,000. That is up to 1,000. If I spend something, will be expenditure. More than 1,000, it will be asset. No problem. No problem. But one thing you have to remember, for every 1,000 rupees or 2,000 rupees you spend, if you keep on taking everything to asset, the list will become too big. If I have something in my asset, I need to keep on checking it every year, whether that is there or not there properly. Whereas if I take something as expenditure, I'm believing that whatever money is spent, I will consume it within that year. For example, eraser. I spent 10 rupees on eraser. I believe that I'm consuming within that year, and I will not bother to keep a list of how many eraser I purchased. I will not be bothered that how many erasers has been half used, full used. At the end of the year, how many erasers is pending? Because this is such a petty amount. If I keep on keeping an account of all this, no, I'll go mad. So that is why they have set a threshold limit of 5,000. So some enterprise sets a limit that 15,000. If anything up to 15,000, I buy, I will treat it as expenditure. More than 15,000, asset. That is also fine. So whatever policy you're adopting, you have to mention this point. So what is the key part of differentiation is amount. But otherwise, asset is what? Asset is something you own it. For you to call something as asset, you need to own it. Second, that asset should help you in generating the business income. And that generation of income or that benefit should come to you for more than one financial year. Asset is something, the value of it should be ideally more than 5,000 rupees. Right? So these points, if you are satisfied, you can take or treat something as an asset. So asset has useful life more than 1 year. Land, infinite years. Building, depending on how old the building is, you can say 20 years, 40 years, 50 years. Plant and machinery, furniture, cash, bank, stock, debtors, investment, all these are the example of asset. If you can see, this is the building. These are all the office equipments. Cash in hand, cash at bank. This is stock. This is investment. Now, land, building, I own it. Plant, machinery, I own it. Furniture, I own it. Cash, I own it because I have in my hand. Bank, the money which is lying in my bank account. Whenever I ask this money to the banker in future, he'll repay me back. So anything that I receive in future is my asset. So bank, by that virtue, is asset. Stock, I own it. It is asset. Debtor is the person from whom I have to receive the money. Customer. So anything that I have to receive in future is my asset. So debtor is, by that way, it is asset. Investment means what? I've invested money somewhere. In future, I'll get that money back. So anything that I receive in future is asset. Software, I own it. So all these are assets. So asset is basically, guys, that in business, there'll be a lot of things you'll be buying. There's a lot of things that you own it. There'll be a lot of things that you have to receive in future. Till where will you keep everything in the memory? It is not possible for a human being to keep everything in memory because the list is quite big. So that is why asset is basically the replacement of your memory, which will remember what all you own it and what all you will receive in future. So these two criteria, if you satisfy, you will find those items on the asset side. Are you clear with what is asset? Yes, boss.
So that the general thing is if it goes about below 5,000, keep it as expenditure.
Yes.
Suppose the particular interest is 3,000.
Interest received.
Yeah.
Interest received is not expenditure.
Yeah.
It is income. So I was talking about difference between expense and asset. Interest received is income, no? So that will go to your income account, trading in P&L account. How it is asset? Asset means if you're now interest is receivable. If you're supposed to receive the interest in future, that will be asset. That will be asset. Don't worry. Whatever I'm discussing with you is just 0.001%. As we go, you'll come across a lot of terms. What is interest income? What is interest receivable? Everything will be dealt in detail. I'm only giving you the plain understanding of the terms. Now, about this particular point, guys, I'll be discussing in detail what is asset versus expenditure. This I'll be discussing in detail when I do the capital expenditure and revenue expenditure, where these points will be again repeated again in detail. because we have a separate concept on this. I'm not touching base that. I'm just trying to make you understand just what is the meaning of asset. Very simple. We'll keep it very simple for next few days, guys. Once we start doing technical questions, no, that time you will get the intricate details of all the items one by one. Now, under assets, I told you there are multiple categories. The first category is fixed asset category. Fixed asset, fixed, something which is fixed. Fixed assets are those assets of the enterprise which are not held for resale, or which are held for not resale, or which are not held for resale. Which means what? I buy this pen with the intention to sell it. Then the motive is to sell this pen. Then I cannot call this pen as asset. If I buy a pen, or if I buy any particular item, let's suppose this pen is for 50,000 rupees. This is 50,000 rupees digital pen. Now I'm buying this pen not for selling purpose. I'm going to use this in the business. In my business, I'm going to use this pen. So when this is for using in the business, then it is called as asset, because my intention is not to resell. Fixed assets are those assets of enterprise which are held not for resale. I'm not holding it for resale, but are used for the purpose of increasing the revenue earning capacity of the business. This pen, what I'm going to buy, this is going to help my business enterprise to increase its revenue earning capacity. One pen can teach 100 students. Let's suppose another teacher, I'm getting another pen. That another pen can teach another 100 students. Example. So the assets what you buy, it will increase the revenue earning capacity of the business. It will increase the earning capacity of the business. Now this fixed asset is classified into two types. One is tangible asset. Second is called as intangible asset. What is tangible asset? Tangible assets are those assets which have physical existence, something which I can touch. Anything that I can touch. If asset I can touch, it's a tangible. Tangible means something which is touchable. Tangible assets are those assets which have physical existence. That is, they can be seen. You can see it. You can touch it. Example, land. Can you touch the land? Can you see the land? Yes. Can you touch the building? Can you see the building? Yes. Plant and machinery, furniture, computer, laptop. All these are assets. Why are these assets? Because these are used in the business, and these have the life for more than one financial year. They have life for more than one financial year. See, when I said in expenses, the life can be more than one financial year or less than one financial year. In majority of the cases, it is always less than one financial year. More will not come. Sometimes it comes. For example, calculator. I buy this calculator. Sometimes you use it for 2 years also. But we treat that, this is the benefit consumed within that year. We assume that these kind of things will not help in the future. It will not get carried forward in the future. By that presumption, we treat this as expenditure. And moreover, the value is less than 5,000. So I will not take the calculator in balance sheet and keep remembering that I have so much calculator. So we treat it of expense and finish it up. When you treat something as expense, nothing should be there in your mind. Game over. If I treat something as asset, you have to keep a track of everything. Which asset is where? What is the condition? Too many headache. So people only take those precious items in the balance sheet which they have to take care of. Do I need to really take care of 100 rupees calculator? For that I need to put an accounting staff, pay him 15,000 rupees salary, 20,000 salary per month. So this is not advisable. So that is why something is treated as expenditure. Now something is called as intangible asset. Intangible assets are those assets which do not have physical existence. That means they cannot be seen and touched. Example, software. Let's talk about software. Can I say this Zoom is a software that we're using in the class? Can I say this is a software? Zoom subscription has to be paid every month. Right? So let's suppose I'm paying 1,500 rupees every month. So this 1,500, will you treat it as expenditure or will you treat it as asset? Think and answer. Will I treat this 1,500 as expenditure? Will I treat it as asset?
You pay for every month or?
I'm paying it every month. Now Zoom software, do I own it? Who owns it? The Zoom company owns the software because they have developed it. They have given me the right to use it. They've not sold the entire software to me. They have given the permission to use the software by making the monthly payment. So first condition itself is paid. So the Zoom subscription that I pay 1,500 per month, I don't own it. Second thing, I don't get the benefit for more than one financial year. I'm consuming that benefit in that financial year itself. So if a benefit is consumed within that financial year, within 1 year, it is expenditure. So from our point of view, the Zoom subscription, what is paid is expenditure. From Zoom company's point of view, they have developed the software. They own it. So first point is they own it. I'm talking from Zoom company point of view. They have developed the software. They own it. Can I say they're getting the benefit from that asset? Benefit in terms of revenue. So asset is something which increases your revenue earning capacity. So that software, when initially they launched, 1,000 people were using it. Then gradually 10 lakh people, then 1 crore people. Today, crores and crores of people are using it. So can I say gradually this has increased the revenue earning capacity of the business? And it is giving you the benefit not only in that year, it is giving you the benefit every year. Of course, you're doing upgradation every year, but the base software is set. The software what I was using 2 years ago, the base is same. Upgrades come. We're not talking about the upgrades. We're talking about the base software. So the benefit is coming for more than one financial year. And the amount what they have spent to prepare that particular software is more than 5,000 rupees. Rather, it is in crores of rupees. So for Zoom company, that software is asset. So here, the software is called as intangible asset. Why intangible? Because can you touch the Zoom software? If I touch, I can touch the screen of this laptop, but I cannot touch the Zoom software. So anything that not be touched or seen is called as intangible asset. Yes, Vishnu. Expenditure from my point of view, from the user point of view, from the business point of view. For example, Tally company. Tally company is again giving the right to use the Tally software. So all of you are accountants. You're using Tally to do the accounting work. Do you own the Tally software? You pay them fees every year. So that software is valid for 1 year. So you're only using it. So who is actually owning that software? The Tally company, which is based out of Bangalore, that is owning the Tally software. So Tally software is an intangible asset for the Tally company. For us, we are the user of it. We are getting benefit every year. After that, the benefit is expired. So we have to again repay. So for us, it is a expenditure. So for the Tally company who's created that software, for them it is intangible asset. Asset because they own it. They get benefit for more than one financial year. And to generate that software, they have spent millions of rupees. So the amount is more than 5,000. So by that virtue, can I say software is asset? But it is intangible asset. Yes, Bhavyansh. Okay, from accounts, it is two business point of view. I'm telling that I'm Tally software company. So I'm a business. From Tally business point of view, that Tally software is my asset. Now let's suppose the point of view is changed. Now I'm the Tally user, customer. I'm the business. From my business point of view, now I'm the user. From this point of view, I'm the user of it. So this is expenditure. So from whose point you're looking at it, that is important. So if you're looking from the point of view of the Tally business, this is the software intangible asset. If you're using the software from the user point of view, user is also business. Ultimately, who uses Tally software? Business people. Who am I using? Who's using Zoom software? I, as a businessman, using it. From my point of view, it is expenditure. So always it is important that you have to use from the business point of view. But who is that business? What kind of a business it is? To that business, what is the relation to that software? That also need to be kept in mind. Now clear with the perspective, Bhavyansh? Okay. Similarly, patent, trademark, goodwill. You'll understand the meaning when I do the upcoming questions. So patent, trademark, and goodwill is also a right that is being given to the business. For example, let me give an example for patent. During the COVID period, the scientists have developed the vaccines. Scientist only knows to develop the vaccine. Does he have the facility to manufacture and produce it to crores of millions of people? Not possible. So Mr. X is a scientist who has discovered the vaccine. The moment he discovers this vaccine, he will get this vaccine registered in his name. The registration certificate what he's getting is called as patent. The patent will tell that this particular vaccine, which is having this and this combination of medicines, this is belonging to Mr. X. Except Mr. X, nobody else can use this vaccine. So this is a patent registered in name of Mr. X. Now what happens is, this patent I'll pay several thousands of rupees and Mr. X is getting in his name. Now what is happening is, by keeping that vaccine, X does not have the facility to manufacture. You need a pharmaceutical company who has invested crores of rupees in the machinery, who can do the mass production, manufacturing. Am I right? So now what will happen is Mr. X will give that patent temporarily to the pharmaceutical company. Let's suppose they give the rights for 10 years, which means that this pharmaceutical company, you can say, what is that? Cipla. Cipla is then what is that? Dr. Reddy's laboratory. These are the pharmaceutical companies. Now what they do is, when they get this patent from Mr. X, will they get it free of cost? They have to pay several crores of rupees. Let's suppose 100 crore rupees is paid by the pharmaceutical company to Mr. X. Mr. X is giving the right to the pharmaceutical company. After making 100 crore rupees of payment, pharmaceutical company owns that patent for 10 years. So that's why asset is something you have a right to manufacture the vaccine. So asset is any right that is owned by the business. Are you able to follow? So in the balance sheet of the pharmaceutical company, this 100 crore rupees, the money is spent, and pharmaceutical company is getting this benefit by selling the vaccines for more than 1 year. Obviously, they are not planning to only do the business for 1 year. It is for more than 1 year. This formula, this patent, what Mr. X is giving to the pharmaceutical company, it is going to benefit the company for more than 1 year. Then this 100 crore rupees, I'll put it under balance sheet on the asset side, under the category fixed asset. Under fixed asset, I'll put in intangible asset. Under intangible asset, it is patent. Right? So patent is one of the items of intangible asset. So this 100 crore rupees is a patent coming under intangible asset. Intangible asset is coming under fixed asset. Fixed asset is coming on the asset side of balance sheet. This is the classification. Okay, not okay. Copyright also. Copyright is, for, let's suppose I'm a singer. No, sorry, not a singer. I'm a composer. I compose the music. Somebody else sings it. So I don't want my composition to be stolen by somebody. So I copyright that, which means that that musical composition is belonging to me, nobody else. If you want to sing it, if you want to, create a song out of it, then you have to take my permission. Then I will give you the copyright. Only if I give you the copyright, you can sing it or you can make a song.
So from the composer's point of view, it will be an asset.
Not from composer's point of view. So here, Mr. X ke badal will have A.R. Rahman. So A.R. Rahman is the composer. So composer has composed this song and he has given this song for, let's suppose, again 100 crore rupees to, let's suppose, T series. So T series has paid 100 crores to get the composition. So from T series balance sheet, in T series balance sheet, the 100 rupees will be what? Intangible asset. Now for A.R. Rahman, this 100 rupees is income, no boss. For A.R. Rahman or for Mr. X, this 100 crore rupees is what? Income. From business point of view, from T series point of view, from the pharmaceutical company's point of view, this is an asset because they own it for a limited period or for an unlimited period. What will be the contract between the two? Yes, boss.
And for the previous one, when Mr. X actually sold his patent.
Not sold. You can say you can temporarily lease the patent. Yeah.
For 10 years. Now, after the period is over, the patent will be back under his name. So the production will stop.
Yes. So the question that is Vishti is asking is, now Mr. X or A.R. Rahman is giving this right, for 10 years. For that, they are charging 100 crores. So on the expiry of 10th year, what will happen? On the expiry of 10th year, the pharmaceutical company will have to stop using that formula. They have to stop the production because the right is over. So the right is coming back to Mr. X. Now Mr. X, again, if he wants, he can give this patent to the same company for another 100 crores or 200 crores by extending more period, or he can give it to some other company.
But they have to formula with them. I mean, company already.
Yeah, though pharmaceutical company has the formula, but the formula is registered in whose name? Who has got the right to use that formula? Mr. X ultimately. And Mr. X gave that permission to use to the pharmaceutical company only for 10 years. So after the expiry of 10 years, pharmaceutical company legally cannot use that formula. If they use that formula, it becomes illegal. So Mr. X can, drag pharmaceutical company to the court. Now point is clear? Yes.
After 10 years, Mr. X will be an asset.
So after 10 years, again, this will come back to Mr. X. So now that is asset. But asset, I cannot say it is an asset. It is just a piece of paper. That's it. For example, Mr. X to procure this, what do you call it? copyright, or let's suppose this patent, you would have spent, let's suppose, 1 lakh rupees. To get that patent work done, that 1 lakh rupees what is spent? No, that is asset for Mr. X, because that is going to give benefit to Mr. X for several years. So that 1 lakh what is spent for getting that patent registered, that is asset for Mr. X. Are you able to follow? Now guys, this is tangible and intangible asset. The basic difference is what? Tangible asset is something which you can touch. Intangible I cannot touch. Next is trade receivable. Trade receivable. Trade means what? Business. Something which is receivable in the course of business is called as a trade receivable. Two example, debtor and bills receivable. Trade receivable, it is an amount receivable upon sale of goods or by rendering of services. I told you in India, you can do only two kinds of business. Either you can deal with goods or services. So if I sell goods on credit, and if I'm yet to receive the money from my customer, that is called as trade receivable, and more specifically it is called as debtor. If I give service to you and I have not taken money from you, I'll take the money in future. So that amount is called as trade receivable. So trade receivable is an amount receivable. Receivable means what? Yet to receive. Yet to receive. So it is an amount receivable upon sale of goods or rendering of service in the ordinary course of business. Trade receivable are of two types. One is debtor, another is bills receivable. Debtor is basically my customer to whom I have sold the goods on credit. So debtor is my customer. From business point of view, my customer is my debtor from whom I have to receive the money. So anything that I have to receive in my future is my asset. So let's suppose there is a person who has to pay me 10,000 rupees. Where will I put him in the balance sheet? Where will I put him in the balance sheet? Asset side, very simple. Under the category debtor, and debtor will come under trade receivable. Under trade receivable, you will have debtor, and under that you will have bills receivable. Bills receivable I'll be discussing in detail in the bills of exchange topic. So as of now, we'll not go into detail. So who is a debtor? Person who receives the benefit. Person who receives the benefit. See, in our case, can I say the customer is the person who has received the benefit? Because he got the goods, he got the service, he got the benefit without giving the money or money's worth immediately. He did not pay the money for that immediately. He said that, sir, I'll use the product, I'll pay later. But liable to pay in near future. Person who receives the benefit without giving the money or money's worth. He did not pay money, or he did not pay money worth of something. He did not pay it immediately, but he said that I'll pay in the near future. So that person is called as a debtor. I need to remember to collect the money from him in future. No? So that is why I have to put him in the asset category. Under asset, what category? Trade receivable. Under trade receivable, debtor. Under debtor, this Mr. X will come. Please understand the flow. This is the balance sheet. Okay. This is broadly asset. So we had fixed asset. Under fixed asset, we are having tangible asset. Under tangible asset, we have the list of item, land, building, plant, machinery. Under fixed asset, we have one more thing called as intangible asset. Under intangible asset, we have list, software, patent, copyright. So this is main category. This is subcategory. These are the sub category or the final account. Under fixed asset, like no. So fixed asset is one category. Second is what? Other assets. Other assets ke andar what will you have? Trade receivable. Under trade receivable, you have debtors and bills receivable. Under debtors, you have the list of name X, Y, Z. Under bills receivable, you have A, B, C. The sub category. Are you able to follow? Then under other assets like trade receivable, you will have cash. So cash you will have in your hand. Some cash you'll have in your factory. Some cash you'll have in your branch office, in which is located in Chennai. Some cash you'll have your branch office located in Bangalore. So in Coimbatore, how much money? In Bangalore, how much money? In Pune, how much money? I'll come. So after cash, next is bank. Other assets ke andar, you have trade receivable, one category. Cash, another category. Bank. So bank, people have account in multiple bank. I have some money in Axis Bank, some money in HDFC Bank, some money in my IndusInd Bank. So I'll mention those bank details also. Bank name also. Then you will have under other assets, you'll have stocks. You'll have stock. Under stock also you have raw material stock, you have work in progress stock, you have finished goods stock, you have traded goods stock. Furniture comes under asset, no? Fixed asset, tangible asset. Furniture, it is fixed. Fixed means what? It is permanent in nature. I mean, when I buy a land building furniture, my intention is to keep them for a very long time. So that is called as fixed asset. If I can touch, it is tangible. If I cannot touch, it is intangible. Are you able to follow? So like that, this is debtor. Debtor is one who owes the money to the business against the credit sale made to the debtor or against the credit sale made to the customer. Correct. How is debtor created? Debtor is created as a result of credit sale. As a result of credit sale. Credit sale means what? I've given the goods, I've sold the goods, but I did not receive the money. Clear with this point? Okay. Bills receivable, we'll discuss it later. Now coming to stock or inventory. Guys, I'm in the business of buying and selling laptops. So I purchased, let's suppose 100 laptops. Is it necessary that at the end of the year, full 100 laptops I'll sell it? Is it necessary at the end of the year, full 100 laptops I'll sell? If possible, I'll sell it. But sometimes the stock is remaining. So let's suppose out of 100 laptops, 80 laptop is sold. Can I say remaining is 20? This 20 guys, I need to remember now that which 20 laptop it is, whether it is Dell, whether it is HP, whether it is Lenovo. Yes or no? If I don't write it down somewhere, if I don't note it down somewhere, can I say there is every possibility that I'll forget it? So the remaining 20 asset is something that I own it. I cannot say this as fixed asset. This is basically your stock. Why it is stock? Because here you're going to sell it in the future. So stock is an unsold goods. So can I say this 20 laptop is unsold goods lying in the business on a particular date for a trading purpose? Now, stock is of multiple types. If you are a trading company, if you're a trading business, then I call this as traded goods. I call this as traded goods. Which means what? I purchased laptop 100 with the intention to sell it. Out of that 80 I sold, remaining 20 is my stock. So I call that as closing traded stock. Or I'll say closing stock of the traded goods, which is 20 in numbers. If you're a manufacturing concern, in manufacturing concern, you know that there are 3 stages. One is raw material stage, one is work in progress stage, another is finished goods stage. Raw material, we give an example of flour, condensed milk, essence. Then what did you say? Chocolate. All these are raw materials. So let's suppose I purchased, let's suppose 1000 kgs of flour. Is it necessary by end of the year I'll consume full 1000 kgs? Not necessary. So I purchased 1000 kgs of raw material. In that 800 is consumed in the manufacturing. So 200 is remaining now. So somewhere I have to make a note of it. So that I'll make under raw material. So this is closing stock. Closing stock means what? At the end of the year, when I close my books of accounts, the stock that is remaining in the raw material category is 200. When I close my business, the stock that is remaining as a traded goods is 20 laptops. Are you able to follow? But let's suppose you're mixing all the ingredients together. And you've formed as a batter. Okay. By the time you mixed all the ingredients, it is 31st of March 2022. Midnight, 11:55 p.m. So after 11:55 p.m., it is next 12 a.m. Can I say that will become next day, which is next day, which is 1/4/2022. Sorry, 22. 31st March 22 ka next day is 1/4/22. Correct? Now, what I'm telling is that day night, you had mixed all the ingredients. By the time you completed the ingredients, the batter was formed, and by that time it was 11:55. And when you kept in baking, the baking process got completed on 1/4/2022, morning 12, let's suppose 1 a.m. Baking takes 1 hour, I suppose. Let's suppose 1 a.m. 1 a.m. the baking is over. My cake is ready. I have not done the garnishing yet. Let's suppose garnishing all, I need another 1 more hour. So effectively, my final product is ready by 2 a.m. in the morning. So 2 a.m. is effectively, can I say, the next day? So next day is the next financial year. So as on 31/3/22, the batter which is unfinished, it is work in progress stage. So let's suppose those are 20 kgs. Then this 20 kgs of batter, I'll classify under work in progress. I'll classify under work in progress. Are you able to understand? I will classify under. I'll classify under work in progress. Now let's suppose on 31/3/22, another gentleman was doing the decoration. So he decorated, let's suppose 100 cakes completed. So 31st March, he has completed 100 cakes of decoration. But that night I cannot sell it. I'll sell it only the next working day. Correct? So in that case, this cake which has been manufactured at the end of the year, the manufacturing process is over. This is called as finished goods. So 100 kgs of cake is lying in the finished goods condition, properly packed in my godown. So I need to make a segregation that how much is raw material, how much is work in progress, and how much is finished goods. This categorization has to be mentioned under the category asset side. Are you able to follow, guys? Online people, are you able to follow?
Yes, sir.
So stock is a raw material. This is from trading business point of view. Now from manufacturing business point of view, stock can comprise of raw material, WIP, or finished goods lying in the business to be used in the production. Raw material and WIP to be used in the production. In the rule you can take last. Lying in the business to be used in production or manufacturing on a particular date for a particular business. Are you able to follow? Now, stock or inventory can be of three kinds. For a manufacturing concern, it is raw material, semi-finished goods, which is also known as WIP, work in progress, and finished goods. Once the manufacturing process is completely packed, completed and packing is done, that is called as finished goods. For a traded business, we call it as a trading goods or traded goods. Are you clear with that? So 4 items will come. 3 in manufacturing, 1 for trading business. Now, guys, these inventories are of, again, 2 types. One we learned as closing inventory. What is a closing inventory? The items that is pending in the business at the end of the year. When I close my accounts, that is called as a closing inventory. So can I say 31st of March is the closing date of the year? Whereas 1/4/22 is the opening of the next financial year. So don't you think that the closing stock of current financial year becomes the opening stock of the next year? So stock is of 2 types, closing stock and opening stock. In the financial year, the stock that is remaining at the end is called as closing stock. And in the next financial year, this closing stock is carry forwarded the next day. So next day is the next year beginning. So it is called as an opening stock. So the closing stock of the previous year becomes the opening stock of the current year or the next year.
So the new gateway will be for opening stock of the.
Yeah, so basically this 200 raw materials closing, no, this becomes the opening 200 for next year. This 20 kgs of batter, which is closing for the current year, becomes the opening for the next year.
So whatever is left in the previous year will be opening stock of the.
Correct. So whatever is lying with the business at the end of the year, that is closing. That when you carry forward the next year, that is next day of the next year, that becomes your opening. So we call it as opening inventory. So stock has got another name. I told you we Indians are obsessed with multiple names. We cannot digest one name. We want multiple names. So stock is called as inventory. It sounds a little bit polished, inventory. Stock is like local. Circle, stock, local. So we're not okay with stock. We want inventory. So again, closing inventory. Is this okay, not okay? Yes, boss.
So can you tell that opening stock is always equal to closing stock?
Opening stock and closing stock will 100% be same, because whatever is the closing of the previous day, that will be the opening of the next day. It has to be the same, no doubt. But value wise, see, that is, for example, closing stock of current year will be the same as opening stock of next year. So this both can be same, but current year's trading in P&L or current year's account will have one opening. No, this will not be same. That is clear. Okay, closing of current year, because this is only getting carry forward now. So this will be same, but next year's closing will be different, no, because stock quantity will be different.
Price will be the cost.
Yeah. So how do we do the costing of it? That is something you learn in the CA foundation. The calculation or the valuation of the closing stock is something which is not there in 11th and 12th syllabus. It is there in the CA foundation. That is called as valuation of inventory, which is given by the accounting standard 2. Accounting standard is basically the accounting rule book. Next asset is, guys, cash or cash in hand. It determines the amount of money that is lying in the business on a particular date. Now, please understand one point. When I'm preparing the trading and P&L, this trading and P&L account is for the entire year. That is, on the day one, I've done 100 rupees of turnover. Day two, I've done another 200 rupees of turnover. So what is my total turnover? 100 plus 200, 300. So P&L is for the entire year, because I want to know entire year's income. I want to know entire year of expenditure. So when I minus both, I will know the entire year of profit. But balance sheet is not of the entire year. Balance sheet is on a particular date. For example, in your pocket, yesterday you had 100 rupees. Today in your pocket, totally you have 200 rupees. Does it mean that you had 300 rupees in your pocket? Yesterday you had 100. Then another 100 rupees you have earned somewhere. Another 100 rupees you earned somewhere. That is how the total was 200. So in balance sheet, I cannot keep on adding the value of every day. That will go wrong. Are you able to follow? So balance sheet, whatever you record, whatever the values you record in balance sheet, no, it is on a particular date. So we prepare the balance sheet on 31st March 2022. So on 31st March, how much money I have in hand? Let's suppose 10,000 rupees. On a particular date, I want to know how much assets I hold. How much money I need to receive from my debtors. Let's suppose 1,000 rupees I need to receive from my customer. So it is on a particular date. So here, cash is the amount that is lying in the business. The businessman is having on a particular date. I cannot accumulate all the cash throughout the year. In day one, I had 100 rupees. In day two, I had 200 rupees. You cannot total it. In day one, you had 100. In day two, 100 rupees more you earned. So you totally got 200. Are you able to follow? Okay. Next is bank or cash in bank. What is this? This is the amount of money that is owned by the business on a particular date, which is lying with the bank. So cash in hand is something which you own it. Correct? No, that's what we learned. And cash in bank is something which you expect to receive in future. So the money which is lying, let's suppose with Axis Bank, whenever I demand from the bank will have to pay it back to me. So anything that I'm supposed to receive in future is asset. So here, as on 31st March, how much money is there in my bank account? That is what you will show it. In the Axis Bank, you have 1 lakh rupees. So that date, what is the value you have, that you will show it. Are you able to follow? All in people, are you able to follow? Ananya, Niharika?
Yes, sir.
Yes, sir.
Now comes investment. Do you understand what is investment?
The money put forward for the benefit of, like, maybe the growth of the.
Point taken.
Suppose I invest 100 crores, expect 150 crores, 150 crores.
Right. Absolutely correct. So there are two things that you can take into consideration. Now, let's suppose this is Mr. X and this is business. Mr. X is giving 10 lakh rupees to the business to start the business. From business point of view, this 10 lakh is called as, from business point of view, this 10 lakh is called as capital. Correct? From business point of view. From Mr. X point of view, this 10 lakh is called as
Investment.
investment. Is that money which which is maybe excessively available with you, that you give it to somebody, and on this 10 lakh you're expecting return. Mr. X is not giving free of cost. In return, what is he expecting? Profit. 20 lakh, 30 lakh, 40 lakh, anything can be expected. So in return, something is expected. So what is investment? You give the money in expectation to return get something in return. So from Mr. X point of view, it is investment. But are we preparing the accounts from Mr. X point of view? No, we are preparing from the business point of view. From business point of view, what is investment? The business is doing the business is doing the normal routine business operation. They earn profit. They have some surplus profit. Now, this surplus profit, they're thinking that if I keep this money idle in the business, it'll be waste now. See, we are working hard to earn money. Now, you should make money, work hard to earn more money. That is the ultimate businessman. I will not call somebody as a businessman only if he is working like a donkey. He should work like a donkey, plus he should make his money also work like a donkey. When both people work hard together, then the probability of becoming rich goes higher. You should work to earn money, then money should earn more money. So now when the extra surplus money, if the business is investing, that is called as investment. For example, I can invest where? In the fixed deposit. All of you know what is a fixed deposit? I go and give this money to the bank. Bank will give me in return the interest on it. Are you able to follow? I go and give this money to the mutual fund. Mutual fund will give me the dividend in return. Dividend is one kind of income. I can go and invest this money in share market. In return, I'll get something. So investment means what? Excess amount of money that is owned by the business, always from business point of view, owned by the business on a particular date, which is allocated to various resources. Various resources means fixed deposit is one resource. Term deposit is one resource. Mutual fund is one resource. Shares debenture is one resource. With the expectation of generating income or profit. Now this money what you've invested, this money should earn more money. Then that is called as investment. Now why do I call investment as asset? Because anything that I expect to receive in future. The money what I invested in bank, let's suppose 10 lakh rupees I gave it to bank. Example I'm telling. I gave 10 lakh rupees to the bank. Will bank keep this money forever with them? They will pay this money in future. Anything that comes back to me in future is called as asset. So this investment in the balance sheet, I'll classify under asset side. Under other assets, yes. Under other assets, I'll put one more category called as investment. In that, if I have in bank, how many FDs in bank? Different FD. I can have an FD for 10 lakh. I can have FD for 20 lakh. So different FD, one account. Then I may have invested in mutual fund. There are multiple mutual fund companies. So let's suppose A mutual fund company, B mutual fund company, C mutual fund company, that keeps on going. Then I might have invested this somewhere else. So that category also you can put it. So under investment, this category, this category, this category. This was.
Investment in bank.
Invest. Now the question Bhavyansh is asking is, sir, you're investing money in fixed deposit bank. So can I put it under bank? So bank here means the amount of money that is available in the bank, which I can take whenever I want. Flexibility is there. That's when I put under this bank. When I say this bank is having 10 lakh rupees, this bank is having 1 lakh rupees, both are different. This 10 lakh rupees I've given to the bank from investment point of view. On this, I'm earning a significant return. This 1 lakh rupees, which is there in my bank account, may or may not earn interest. Because if it is a savings bank, then you can earn 4% interest. But that is not investment. The bank is telling that if you are putting 4 lakh rupees in my bank account, keeping it just in the bank account, I'll pay you interest. If you want, you can use it whenever you want. But fixed deposit is not like that. Fixed deposit, if I put it in bank, I cannot use it. It is locked. So for that, I'm getting, let's suppose 8% return. Example. So here, if it is your current account, now what is savings bank account? What is current account? I will explain this when I do the bank reconciliation statement. That I'll be explaining in detail. Just understand. Saving banks is like whenever you want, you can put the money, take it out. For that, they're giving 4% interest. Example. Then there's something called as current account. In current account, the bank does not pay you the interest. It's just the money lying in the bank account for doing the transaction purpose. All along. So what is SB account? What is current account? What is fixed deposit? Everything we'll discuss in detail in the BRS chapter. I'm just trying to make you understand. The question is good. But Bhavyansh, again this point, when you come to company accounting, what you say to some extent will get satisfied. Because in company accounting, we have something called as cash and cash equivalent category. Under this, cash in hand, bank balance, the money which is there with the banker for a temporary period of 3 months or 6 months, this will come here. So again, there is a lot of ifs and buts attached to this. If this condition satisfied, this will come under cash and cash equivalent. If that condition does not satisfy, then that becomes an investment. So the critical parts are yet to come. I'm just now keeping it very simple. very, very plain and blank. Are you able to follow? Investment is something that I've put the money somewhere in order to earn the return in future. And whatever money I've invested, this money will come back to me in future. So asset is something which I expect to receive in future. Simple. So where will I put this? Will I put in trading and P&L account? Will I put this in trading P&L? No. Will I put this in balance sheet? Yes. Will I put in
Yes.
liability side? Because liability reminds me of to whom I should pay. Asset will remind from whom I should receive. So I should receive this investment from whom? From bank. Is it understandable? Ananya, Niharika, comfortable?
Yes, sir.
Yes.
Yes,
So guys,
sir.
we have only discussed very, very few terms pertaining to trading P&L and balance sheet, or even you can say about accounting. There are not many terms that we are yet to discuss. For example, what is current asset? What is non-current asset? What is current liability, non-current liability, fictitious asset, capital expenditure, which we just had a glimpse of in the class. Capital expenditure, revenue expenditure is discussed in detail in some other chapter. Fictitious asset will get discussed in another chapter. That is capital, revenue, and deferred. These three will come together. Prepaid expenses, outstanding, accrued, outstanding income. This will come in a different chapter. That is basically a journal entry. This will get covered. Your invoice and voucher will get covered in a chapter 7. This cash discount and trade discount will get covered in a journal entry chapter. So like this, there are certain terms which you have to learn it now. And there are certain terms you have to learn it then and there in the chapter. Because when I correlate with the practical questions, you'll be able to digest it very easily. If I take everything now, everything will be scattered. Nothing will seem organized. So I'm just giving you a feel of what is asset, what is liability, what is income, what is expense, what is capital, what is loss, what is gain. We'll keep it very bland. So once we go to the practical questions, when we upgrade the chapters one by one, lot of new things again will come. So that time I'll keep on giving the explanation at that point of time. So it will start making sense. Now I'm just given a very bland explanation. So with this, I complete my basic terms of accounting. Right? In your current book, there'll be a lot of other terms. For example, business transaction. All of you know what is a business transaction. Transaction is something happening between two people, and that should be in the event of business for monetary value. Account. Account, I can say what is account. Account is basically a place. Account means count. Account means to count. I said you cash account. What is cash account? See, in business, a lot of times money comes in and goes out. So let's suppose, 100 rupees came in, 80 rupees went out. So what is the balance? 20. So getting this balance is a byproduct of counting. I counted 100 rupees, which came in. I counted 80 rupees, which went out. So what is the net count? 20. So the process of doing this work, the process of getting the balance is called as accounting. It is a record of transaction under a particular head. Salary. For example, I paid salary, let's suppose to X 1000. To Y, I paid 2000. So don't you want to know total is how much salary you pay? Total is how much? 3000. The process of adding all the similar or same kind of nature of transaction, we call it as accounting. Account means to count, to accumulate. If I want to know the total salary, so I'll open a salary account. In that, every month, how much I paid to which fellow, to whom all I paid, I'll take a total of everything. If I want to know what is my total expense, I'll open a telephone account. For each item, you'll open an account. Are you able to follow? For example, this is very common. People go and open tea account in bakeries. You've seen in movie now. That hero goes, he has one 10 rupees cup of tea. That fellow says that, Kaas kudupa. He's like, Anna, account la potrunga. Keep it in my account. Means what? Account means what? You keep it in your remembrance. Make a note of it. So this fellow goes and this happens also in college. Some people develop a very good rapport with the canteen person. So he says that today I've had for 100 rupees. Tomorrow he'll have for 150 rupees. Then for 50 rupees. So the bakery guy or canteen guy will have a separate notebook for Pratik sir. And he'll keep a total. And he'll say that at the end of the month, total is 2,500. So I'll settle this amount. So how did you know this 2,500? Because by way of noting it. The process of noting the amount is called as accounting. Are you able to follow? It is a record of transaction under a particular head of account for a particular category or a particular head, it not only shows the amount of transaction, but also shows their effect and direction. Now, what is the meaning of effect? What is the meaning of direction? That is something you'll get to know when I do the trading P&L and balance sheet. For example, this 20 rupees, like 100 rupees is the money coming in, 80 is the money spent. Balance 20 is the money in your hand. What is the meaning of this 20? This is the balance money in your hand. So it is your cash in hand. It is your asset. So this is the effect. And direction is what goes to the balance sheet. Now, guys, 1,000 rupees I paid salary to X, 2,000 to Y. Total is 3,000. So this 3,000 in effect I call it as expenditure. So effect is expense. Direction, it will go to your trading and PL. Are you able to understand? Niharika, Anani, are you able to follow, ma?
Yes, sir.
Capital,
Yes, sir.
something which we discussed. Drawings we know, liabilities we know. Of course, current liability, I have not discussed this particular point. Maybe if time permits, I can discuss with you on some other day, because this is quite complicated for you to understand at this level. But when you come in 12th, you'll understand in detail. Maybe if time permits, we'll discuss somewhere in between, not a problem. Assets, we've discussed what it is. I said to you that non-current, current, and fictitious is still pending. That is current liability, non-current liability pending. Current asset, non-current asset, fictitious asset pending.
There's no fictitious liability.
No fictitious liability. We have discussed what is fixed asset, tangible, intangible. Current asset we are yet to discuss. Fictitious asset we are yet to discuss. Expenditure we have discussed. Normally, what is expense we discussed, but we have subcategory. What is capital expenditure? What is revenue expenditure? I've kept it pending because this is again covered in detail in another chapter. And deferred revenue expenditure. The three categories of expenditure: capital, revenue, and deferred. If I explain this three, no, it will be very complicated because a lot of things you still don't know. So only after making you certain understanding of the concept, then if I go and explain these three, now things will start making sense. To be more precise, I'll be explaining these both in the depreciation topic. Normally, expenses we have discussed. Now, prepaid outstanding. This is something I'll be discussing in chapter number 8, journal entry. Income I've just casually discussed. Profit we have casually discussed. I told you gross and net we'll be discussing in detail when we do the trading and P&L. Gain loss we have discussed. Purchase return discussed. Sales return discussed. Revenue from operation we'll discuss when we do the higher chapters, or maybe this in detail you come in the 3rd volume of your 12th standard. But here there's one chapter, a small one or two sums is based out of this. So this I'll explain when I do that. Goods we have explained. Stock and inventory explained. Opening stock, closing stock explained. Raw material explained. Work in progress explained. In trade receivable, we have only discussed debtor. Bills receivable, I told you we'll do it in the bills of exchange chapter. Trade payable, we have done. Creditors explained. Bills payable in the bills of exchange chapter. What is cost, voucher, discount? All this will be explaining in the upcoming chapter. For example, trade discount means what? Cash discount means what? We'll be discussing with the practical question in the journal entry chapter. When you do the journal entry, I'll be discussing what is trade discount and cash discount. I'll give a practical example so that you can relate to what I'm talking. If I discuss now, something is going to head, but you'll not be able to relate to that. What is bad debts? Future, we'll discuss. Balance sheet, upar se I've discussed with you. Book value, we'll discuss in future. When I do specifically depreciation, you'll understand what is the book value there. Books of accounts, we have discussed. The first topic of this chapter is books of accounts. Cost of goods sold, yet to discuss. Credit and debit, we'll discuss in the next chapter. The rules of debit credit. We'll start with this only. Without this, there is no accountancy life. This is the heart and the brain of accounting. Without these two, there is no accounting only. Depreciation we'll discuss in detail in the depreciation chapter. Entity. Entity is basically the business enterprise. Reliance business. We call it as entity. Entity is also called as enterprise. Organization. Name basically. Bajaj Auto is a business enterprise. Maruti, Reliance. Then you call your Fortunes Fund Learning Academy. What is this? All these are business enterprise. So many, see, entry, insolvent, proprietor, all this will come in future. Everything will be get covered, guys. Don't worry. If I overload too much now, everything will go upper side. So as of now, we'll keep it very simple. So far with whatever we have discussed, do you have any doubts? Comfortable? Easily digestible? Okay. Offline people are comfortable?
Yes.
Online people, Ananya, Niharika, how do you find it?
Yes, sir.
Yes, sir. Getting it.
I'm comfortable with it.
Super, super. Now in the next class, guys, we'll be jumping to chapter number 6. So you may be wondering, sir, you took first chapter, only first 2 pages, remaining Govinda. Second chapter you did it, that to 50, 60 you've done. Third chapter where gone? Fourth, where did it go? Fifth, where did it go? Straight away sixth. Now, this is the order given in textbook. If I take in this order, you will not understand head and tail of the accounts. The order in which I'm taking, out of my 4 years of experience, if I go with this order, I'm trying to organize stuffs in a way which makes a meaningful, structure. For example, your third chapter talks about a lot of rules and regulation, matching concept, this thing, that thing. For that, you need to first do a little bit of accounting. And then if I come and give examples of those things, then you'll understand. So in third chapters, there are certain concepts. When I do the upcoming chapters, I'll be doing it parallelly. And there's certain concepts which I'll do it at the end. Fourth, I will do along with a chapter. Fifth is accounting equation. So a lot of schools, they start accounting equation. You will only end up by hearting. You know the formula that asset is equal to liability plus capital. That's it. But why is asset equal to liability plus capital? Under liability is what all coming. Under capital, what all is coming. Under asset, what all is coming. If I do plus and minus, you do minus in that. Why you're doing minus? Why you're doing plus? There is no conceptual clarity. You only keep on by hearting. So this chapter, accounting equation, if you do after journal, ledger and trial balance, and then if you come and do accounting equation, you will understand why you are doing. If I'm adding something, why? If I'm minusing something, why? So I'm not actually breaking the order. I'm setting the order for it. I'm setting the right order. If you go in this order, things will make sense. So do you all trust me? No doubt in that? Yes. So my job is to make your life easy. So all the research, all the hard work, all the back-end work has been taken care of. This has been followed in last 4 years. The same thing we're following even now. If they are comfortable in scoring well, so can you also. So with that positive intention, we'll go and head forward to chapter number 6 in the next class. The next class is going to be super duper important, where we're going to learn what is debit, what is credit, what is the golden rule of accounting, what is the modern approach. So next chapter is the base. Like without this chapter, your 11th and 12th is like totally gone, screwed. This is like the proper foundation to construct a building. We have a strong foundation now. That this chapter is that foundation. This is going to be the foundation of the entire accounting. If this is set right, 50% is done. If this is not clear, then you're screwed. A lot of people have this 11th accounts very shaky. In 12th, they are royally grilled. Here, if you're keeping this base strong, 11th will be super strong, 12th will be super duper strong. Clear with this point now? So online people, do you have any doubts?
No, sir.
No, sir.
Okay. So on that positive note, guys, I put an end to today's session. I'll see you all in the next class, which is Saturday. From 7 to 8:30 p.m. Until then, bye-bye. See you. Take care.